Good evening, everyone, and welcome to tonight's webinar, From Debt to Ownership, Navigating Student Loans and Starting Your Practice. My name is Chris Okowski. I'm ASDA's Business Development Manager. I'm pleased to welcome PNC Bank as the sponsor of tonight's programming. We're glad you've joined us this evening as we have an informative and interactive presentation planned for you. During the presentation, we encourage you to submit questions via the Q&A feature. We would now like to introduce our presenters from PNC, Stephen Elias and Michael Olson. Stephen is an Assistant Vice President, Campus Relations Manager at PNC Bank Student Lending. He brings extensive experience in guiding students and their families through the complexities of financing higher education. With a strong foundation in financial aid and student lending, he possesses a unique blend of technical knowledge and personal insight into the financing needs of students at every stage of their academic journey. With a passion for education and financial literacy, Stephen is dedicated to creating a seamless and supportive experience for students and their families, helping to lay the foundation for long-term success both in and beyond the classroom. He has conducted various presentations at national, state, and regional financial aid conferences across the country. Mike is a seasoned healthcare professional with extensive experience in private practice mergers and acquisitions, private equity, financial services relationship management, and healthcare product management. Mike serves as a healthcare industry subject matter expert and is a frequent speaker at medical and dental schools. Please join me in welcoming Steve and Mike.
And to begin the presentation, I'm going to first talk to you about student loans and also financial wellness. During the presentation, if you have any questions, you can ask the questions in the Q&A and then click the send, and then we'll be answering your questions during the presentation. Our objectives this evening are to understand repayment of federal and private student loans, evaluate whether extending, consolidating, or refinancing your loans aligns with your financial goals, apply actionable strategies to manage and repay student loans effectively. Then Mike will talk about exploring pathways and opportunities to achieve practice ownership and recognize the key differences between healthcare specific lenders and traditional banks. For the student loan section, we're going to talk about student loan types, federal versus private loans, and refinancing student loan debt. Then in personal financial wellness, we'll talk about the 50-30-20 rule. We'll give you some budgeting tips and also talk briefly about retirement planning. We're going to go ahead and start with a poll. What year are you in dental school? And if you'd go ahead and select an answer that's appropriate for you. Great, thank you. And we can see the results here. It looks like many of you are recent graduates. Then we have a good mix of some D1s, D2s, D3s, and D4s. To talk about the various student loan types, the direct subsidized student loan is the loan that you probably had when you were an undergraduate student. And for that loan, the government pays the interest while you're in school or during deferment periods. Then there's the direct unsubsidized student loan, which possibly you also had as an undergraduate, but more likely had as a dental school student. And with this loan, you, the borrower, are responsible for all of the interest. The government doesn't subsidize it. Many of you in dental school may also have the Graduate Plus loan. And this is where you, as the dental student, would be the borrower. Some of you may have had private student loans as an undergraduate or possibly in dental school as well. And this is where credit-worthy borrowers are students, and in some cases, a parent or other relative or friend may be the cosigner. In fact, even if you qualify on your own, you may consider having a cosigner to get a more attractive interest rate. Looking at federal loans versus private loans. For federal student loans, they're offered by the federal government, and the actual lender that you repay is the federal government through one of the many services that they have. It offers a fixed interest rate with flexible repayment plans and benefits like public service loan forgiveness. In fact, public service loan forgiveness is one of the things that might change in student lending and financial aid based on the current budget reconciliation that is going on in Congress. Private student loans are offered by banks, credit unions, and other private lenders. They offer either a fixed or variable interest rate. They do offer flexible repayment options, and eligibility is based on your income and credit. So it is a credit-based loan. Here is our next poll question asking about your student loan borrowing. Do you have no student loans, which would be great? Did you borrow only as an undergraduate, graduate, or only in dental school, or both undergraduate and dental school? We'll take a few moments as you answer. Hopefully, many of you come up with no student loans. That traditionally isn't the case, but in fact, on average, dental students do the highest borrowing, unfortunately, of any discipline, including any of the other professional schools. So in a moment or two, we'll see some results, and here we go. And it looks like most of you borrowed only in dental school, which is great. So that means you haven't brought a lot of undergraduate debt with you, which will certainly bode well when you ultimately go into repayment after dental school. Now, you do have the option after graduation or leaving school of refinancing your student loans. And some reasons why you may want to refinance would be possibly to get a lower interest rate. And certainly over the last several years, interest rates in general in the country have been high for everything, including mortgages and car loans and personal loans, but student loans as well. So when you're after you graduate and in repayment, the interest rates may go down, so it might be worth refinancing. Also, refinancing lets you simplify your loan management. Now you generally would borrow one loan per academic year if you're borrowing just in dental school, and you might have some Graduate Plus loan and other debt as well. So you could really refinance all of that into one single loan to make it easier to manage in repayment. And also, depending upon what your repayment term is and what you choose in refinancing, it could possibly shorten your repayment term and thus save money over time. There are risks of refinancing your federal loans and your private loans together. If you refinance them together on your federal loans, you could risk losing benefits like income-driven repayment plans, deferment, or certain forbearances. And the income-driven repayment plan and some other repayment plans of the federal student loans are also something that probably will change as a result of reconciliation with Congress. So stay tuned and check with your financial aid office or your federal student loan services for more details. I'm sure there'll be a lot written in the media as well. Also, if you refinance your federal loans with your private loans, you may potentially lose eligibility for public service loan forgiveness. And those of you who are going into practicing dentistry in the public service arena, you probably would not want to refinance your federal loans with your private loans because, at least as of now, you'll possibly have eligibility for loan forgiveness. How to choose a lender to refinance your student loans? You're going to want to think about these features. You want to compare loan options, including what fixed or variable rates the lender may offer. You want to check into what the terms of repayment are, often either 5, 10, 15, or 20 years. Some lenders actually even offer repayment beyond 20 years. So in that scenario, you'd have lower monthly payments for the longer time period, but you pay more over time because you're paying for a much longer time. Then also you want to see if there are any fees, and most lenders do not currently have fees on their private refinance loans. Also, you want to certainly look into lender reputation. You want to research customer reviews of the lenders, look at things like Better Business Bureau rankings, look at how long they've been in business. Some student lenders come and go, others like PNC, we've been in the student loan business for over 50 years. So you really want to look into the lender's history. Also, you want to see if maybe you have some other banking solutions with a certain lender, and you might want to see if they offer student loan refinancing, if it's a lender that you're already working successfully with. Some questions to ask a lender. What are the current interest rates and how are they determined? Are there any penalties for prepayment? And generally there are not. So what often happens, especially with professional school students, including dental students, in the early part of your career, you might be making just your expected monthly payments, but as your career goes on and your income grows, or if you have some bonuses or something like that, you can earmark additional payments to pay off sooner without penalty. You also want to ask, are there any hidden fees? Certainly you don't want any surprises. And generally in the industry, there are not, but you do want to check on that. Then you also want to see what the income requirements are, not necessarily the amount of your income, although that's part of the process, but do they have a minimum expectation of time that you've worked out of school and that kind of thing? Also, is there a discount for auto pay? And many of the lenders do offer a discount of either a 1/4% or we offer a 0.5% discount for auto paying. And the other thing auto payment is great about doing is helping to make sure you pay on time. And then that obviously keeps your credit looking very good. And then what support is offered for financial hardships? Hopefully you won't have any financial hardships, but it's really important to have a lender that would be willing to work with you. And I strongly encourage you, as soon as you have some financial difficulties, if you do, to contact your lender and let them know and try and work with them. Many of the lenders are certainly able to offer you some options, sometimes either lowering the payments or even pausing the payments for a period of time as well. but it's best to be upfront with the lender and let them know before you really go into arrears on the loans. Now we're going to talk about financial wellness. So we're going to talk about some things a little bit other than student lending. So you're going to want to go ahead and focus on that. And I do encourage you again during the presentation to go ahead and put any questions that you have in the Q&A. And we're going to start off with another poll question. Do you use a monthly budget currently? And this is really to get an idea of how many of you do budgeting and hopefully stick to that budget on a monthly basis. And certainly it's important while you're a student on probably a limited budget in many cases, but it's certainly also important, as we'll see going on in your financial life as you go on in your career. So we can see right now about 61% of you don't currently use a budget. Well, almost 40% of you do. So congratulations to those of you that do. For those of you that don't, you may want to consider doing so, and we'll be able to hopefully give you some tips to help with that this evening. What is the 50-30-20 rule? And that talks about 50% of your budget going for your needs, things like housing, utilities, groceries, transportation, things on a regular monthly basis that are needs. 30% would be set aside for your wants. And these are the non-essentials that you purchase, things like dining out, entertainment, and travel. And then 20% for savings and debt repayment, things like emergency fund contributions. We'll talk about that in another slide or two a little bit more. Retirement savings and maybe making extra loan payments, as I talked about earlier. An example is if your monthly income is $5,000, 50% of that or half would go towards your needs, things like rents, utilities, groceries, and car payment. Then the 30%, the $1,500 for the wants, certainly allowing for you to have some enjoyment, but trying to limit it. Things like dining out, hobbies, subscriptions, those kinds of things, including streaming services and so forth. And then savings and debt, the 20% or $1,000 in this example, things like 401k contributions, student loan payments, and your emergency fund. Everyone should have a budget regardless of their income. We encourage you to create a budget and keep in mind that 50-30-20 rule that we just spoke about, talking about your needs and your wants and then savings and debt service. And there are a lot of great tools out there, a lot of good apps to help you with budgeting. And it really makes it easier than ever. And you'll obviously have this right on your phone. Some good apps out there are EveryDollar, and this is a budgeting tool to help you see where every dollar is spent, as the name denotes. And in some cases, you'd be pretty surprised where your money's going on a regular basis. And then there's You Need a Budget, another popular app, especially with students. I encourage you to find an app or process that works for you and stick to it. And it's important, the more in line with you and what's important to you, the process or app that you're using is, the more likely you are to utilize it on an ongoing basis. Also, we encourage you to integrate loan payments as part of your fixed expenses in your budgeting and making sure you pay those on time like all of your other bills. Now we'll talk a little bit about overcoming obstacles in budgeting or in your financial life. And one of the things a lot of people fall into as a trap is lifestyle inflation. And that's spending more as your income increases. And hopefully, with all of you, your income will go up over time, but you certainly don't want to necessarily spend upwards as your income is going up. And a great solution is to make sure you have an automated way of savings to stay disciplined. That way, you know that you're paying yourself just like you're paying everyone else with your monthly bills. Variable income is something else, and it's kind of common in the healthcare career industry, especially if you're in an area where you might have a bonus, either monthly or quarterly or annually. And a great solution to address that really is to base your budget on minimum expected income. Many people tend to do their monthly budget based on their maximum expected income, and that's where they run into problems, especially in some of the leaner years. So if you plan conservatively, you'll have much better success. Then also, as I've mentioned a few times, you want to make sure you're building an emergency fund. Aim for 6 months of living expenses for those unexpected events. We never know what can happen. If we think back, it was recently as a few years ago during COVID, many businesses, including dental practices, had a dramatic decrease in their income. So you want to make sure you always have something set aside in case some unexpected things occur. Generally, you want to start small and grow as your expenses grow to make sure that your emergency fund grows accordingly. We're going to talk a little bit about saving for retirement now. And certainly we encourage you to save as early as you can. And that's because of compounding interest. Your contribution grows over time as you earn interest on both the principal and accumulated interest. For example, investing just $200 per month starting at age 25 with an 8% annual return can grow to over $600,000, over $500,000 by the time you're 65. To show starting early and how important that is, if you were to defer just 10 years and start saving that same $200 a month at age 35 instead of 25, this reduces your amount in half to only $300,000 by age 65. So it really is a great example of starting to save now is important. And again, this is an adage that is true today as it ever was. Time in the market is more critical than timing the market. And it's much better to just sort of take the slow and steady approach rather than trying to, have some great investments that you think are down the road that'll catch you up, because they almost never do. Types of retirement accounts. There are the 401ks, which are generally offered by for-profit companies, 403bs, which generally are offered by nonprofits, religious institutions, and some government entities. Then there are others that are generally not related to working. The traditional IRA, where tax deductions are upfront and withdrawals in retirement are taxed. At the age of 73, you have to start taking a withdrawal if you haven't already started by then. And there is a penalty if you withdraw earlier than the age of 59 and a half. There's some tax penalties. And then there's the Roth IRA, which is after-tax contributions that you contribute to the Roth. Withdrawals in retirement are tax-free as a result because you paid the tax up front. And there is that same penalty if you withdraw earlier than age 59 and a half. Here are some additional resources for you to consider. And many of these were sources during the slides that you saw in the fine print. So there are some great resources for you. Are there any other questions at this time? Before I go ahead and turn it over to Mike to talk to you about starting a practice?
One in the Q&A.
What are principal and accumulated interest? Great question. The principal is the base amount that you borrowed originally, and then accumulated interest. On many student loans, the loans are deferred while you're in school and up to 6 months after graduation or leaving school. So for the unsubsidized loans and the private loans, interest accumulates while you're in school, and then it basically gets added to the principal once you enter repayment. Excellent question. Thank you, and now I'll turn it over to Mike.
Well, thank you, everybody. Great job there, Steve. So I have the pleasure to speaking to you all on PNC Healthcare Banking. I am in the healthcare banking group. We work with private practice owners in dental, medical, and vet. About 50 to 60% of our clients do come from the dental space. So this is absolutely one of the key areas that we do focus on here. And I'll kind of go through this. I know we have a little bit of time left, but I kind of on the high level capabilities of our bank, and this is something that you're going to keep in mind as we go through this presentation. We're a full service bank, meaning we don't just do your loan. We're here to be your partner in your practice, your operation, your cash flow, how you pay your vendors. We do all the different things as money comes in and out of your practice. So I know right now you're in school, you're focusing on your clinical, so I'm not going to spend a ton of time on all of these things. But I would tell you that acquiring a practice is just the beginning. When you go to pick your banking partner, you need somebody, all the banks can provide a loan for you, but who's going to be there to help with your credit card processing, your online banking? Who's going to have some tools to help prevent your practice from fraud and embezzlement, things like that, right? And then over the things that Steve just talked about, mortgage services, retirement planning, maybe first-time home purchase, maybe you have children, you want to save for retirement. So PNC Bank, we do all these things, and we have high level. And so before we go on, just like Steve had his polling questions, I'd love to ask you here, who is considering getting into private practice ownership? So it's an easy yes or no question. So we'll go ahead and give you that one. And kind of as we talked about earlier, my background is in independent physician. I did a lot of lending in that space, but I also worked for a small group here in Chicago. I did their M&A work, and I bought about 100 practices. And so yes is 21. Now, I will tell you, that does surprise me a little bit. I do this quite often. I am seeing a lot of your colleagues saying that they're not necessarily interested in private practice. I love seeing that you guys are. We do see some that are looking to go into DSOs, corporate dentistry, and that's great. And but I really love the entrepreneurship. This is where my passions lie. So before we start talking, we're going to go through really quickly here about personal credit. So when you look to manage your personal credit, there's a couple things here: commercial lending versus consumer lending. What's the best way to get into maintaining all those things? The number one thing you can do is check your credit report. There are things on your credit report you may not be aware of, right? Maybe in undergrad, you had a roommate and you left early and they stayed through the summer. And then maybe they didn't pay the last water bill, the electric bill, maybe they didn't pay the last rent, and your name was on the lease, you might have a collection. Maybe you have a parking ticket from when you were 20, back in undergrad as well. A lot of different things can show up on your credit report. So there's two great resources there at the bottom, okay? Your annualcreditreport.com and myfico.com. Now you'll be able to get one of your scores from one of the three bureaus there. If you want to get all of them, you might have to pay. I don't know if anyone here has actually gone where you've gotten those letters that say you were part of a data breach, or your social security and your name was, breached somehow. Those also supply you with like a year of free credit monitoring. That's also an opportunity for you to get an idea about your credit report. You can maybe put a watch on your credit so no one can pull that, right? And I don't know how familiar people are with their credit scores, but this up at the top, obviously the range of 300 to 850, the higher the better, right? This isn't like golf where you're trying to get under par. Here, we're trying to get higher scores. So as you can see, and as a rule of thumb, PNC Bank and a lot of the larger banks, we're going to want your credit score in that 700s. Now, can we do a deal that's lower? Yeah, possibly. But just as a safe rule of thumb, the higher the better, right? And we obviously don't want to be down in the orange. You have to really try to get your credit score that bad. Making your payments on time and doing all those things. We're going to talk about this a little bit, what things impact your credit score, but let's try to stay up at the top there, okay? I don't think anyone's surprised. Now this, in all my years, 30 years of being out of college and being in banking, I probably never knew about this until the last 2 years when I started doing this presentation. Here are the key factors that make up your credit score. And I don't think anyone's surprised. Payment history. So past performance on your payments is the really indication the bank's going to use on how future you're going to be, how you're going to make payments, down the road. And so payment history is the number one, right in the middle, 35%. Now the amount owed on the right is 30%. Now I know we've already been talking about student loans. The bank's aware that one of the key reasons, number one, it's really hard to be a doctor. You have to study, you have to be smart, you have to put the time in. It's also very expensive. And so one of the barriers to entry to be a medical dental vet is the fact that you go to school and it costs a lot and you have student loan debt. So we do understand the amount owed. And that's why the amount owed and then the credit mix and the type of credit it is, that 10% right there. Is it unsecured debt like a credit card? Is it student loan debt or a car note? Is it a mortgage? All those things are kind of factored in a little bit differently based on what type of debt it is. And then length of credit history. So the longer you have credit and the more the length that you have a history, the higher your score can be. And then this new credit here. It could be alarming for a bank if they see somebody running out and opening up 10 new credit cards. What's going on? Why is somebody doing that? What if somebody goes out and buys 2 new cars? It could be a sign of some financial distress. It could be a sign of making some decisions that might not be in the best interest of me giving you a loan if I know all these other loans have just been taken out. So again, time and length of history there. So so far, hopefully all that makes pretty good sense to everyone. And sorry, I just skipped 2 there. So here's a really cool thing that kind of shows what actions that you do in your life, like what can happen, right? What type of situations can we get in if we do these things? Now, the person on the left, right, already has a pretty low credit score. Like, right, that's not a great credit score. And I don't think anyone's surprised at that. They have a low number of credit accounts. 8 years may seem like a lot of time, but that's really, from 18 to 26. You're still a little bit younger in the credit there. Revolving utilization, meaning if you had $1,000 available on a credit card, you owe almost $700. So that's, that number's kind of high. You've had a 30-day delinquent and you had a charge off. All things are negative that will ding you. The person on the right, though, longer credit history, much lower utilization. So even though they owe 6,500, which is more than the 5,700, they have a much larger available balance, and they've shown that they're only using a small portion. They haven't been late. They haven't had charge-offs. So they're being pretty consistent with their spending, and they're being very consistent with their payment history, and hence why their credit score is so high. Now, our same 1 and 2 people right here, what happens if you do certain things? And the biggest thing that I would say here is if you look at the top one, if you miss a payment by 30 days, 607, you may only go down 20, 30 points there, right? And that's because you've already had late payments. So the first late payment you have impacts you much harder, because if you look on the right, the 793 credit score could potentially go down 80 points. So that's a really big go down right there, right? So I see some Q&As here. Let me, what kind of IRAs? Is a young credit score a drawback when trying to get a loan to open a practice? International dentist. Okay. So, Dr. Garcia, one of the things I would say there, right? I'm going to answer this live. We do, and this will be answered later in the presentation, but we do ask that you have 2 years post dental school graduate, right? And so you're being a young credit score could have a little bit of an impact. Yes, it could. But in those 2 years that after you get out of school and you go to buy a practice, focus on those things that we talked about, making your payments on time, keeping your revolving balances down. What's a good percentage of credit utilization? The next one. I would try to keep it under 50%. Okay. That's just a rule of thumb. If it's 90 or 100%, obviously really bad. In that example before, we were down at 12%. So again, 50%, it's okay. I would recommend that you pay your credit cards in full, but if you do have a revolving balance, let's try to keep it down. And that's why a lot of times we tell people if you do pay off a credit card, don't hurry and rush out and then like close it. That's going to take whatever balances you may have and it's going to exaggerate the amount of outstanding, right? So if you have 2 $5,000 credit cards and you owe 5,000 on one, 5,000 on the other, so you're maxed out, you pay one off and then you go and close it, you're still in the same position you were. It would be much better off to have that 5,000 available, 5,000, and you have a 50% utilization. So great questions there. And then here's some of the other things here. As you can see, credit scores go up if you reduce your revolving account balance by 25%. So you're in that 60%, like, you get above 50, you owe $6,000, you have 10,000 available. You pay that down 25% of 6,000, 1,500. You lower that down, your credit score is going to go up. So again, great things occurring there. And again, maxing out your credit cards, huge hit to the person on the right. 130, that's definitely a sign that something bad happened. Missing payments by 90 days obviously is not great either, right? So no one's surprised, I think, at any of those. So past the practice ownership, we kind of talked about personal financial management. I know that Steve gave some great pointers earlier. I'm going to talk a little bit about timing. As I mentioned earlier on that poll, on that question, we do like to see 2 years post-graduation for people to own their own practice. That is not a hard, fast rule. We have done, in a year, people a year out of school. GPRs, you go do a general practice residency, that can count as well as experience. So maybe 1 year GPR plus 1 year of experience at a DSO or a private practice, going to work as an associate, all those matter. And then lifestyle. How much do you want to work? Are you looking to be full-time, 4 or 5 days a week? Are you going to be raising a family, get married? Are you going to be moving? Do you want to rent your home? Do you want to maybe not be in the area, like you don't want to buy a practice in the city of Chicago if you're thinking about moving to New York. So that lifestyle and how you want to live makes a big difference. And so when you look at all those different things and you decide, what am I going to do? There's a lot of different choices you can have, right? You can continue to be an associate. You can go to specialty school. You can go do a GPR. And here are the transitions, right? There's three main things that you can do. I always start at starting a new practice. It's something that I'm least familiar with. I've definitely financed them. I've actually been a part of one of them, but they do involve a little bit of risk, right? The day you open your doors, you have no patients, your staff you just hired, you had to order supplies, you had to do maybe a build out. And so you basically come out of school, you work as a dentist, and now all of a sudden you have to be a real estate specialist, sign a lease, do a build out. You're a construction specialist. You have to hire new employees. So now you're an HR specialist. You got to set up benefits. You got to go, and if you're going to be in PPOs or HMOs or Medicare, you're going to have to go and get enrolled in insurance plans, right? You're going to have to go get insurance on your building, insurance on your equipment, insurance on yourself, life insurance. All of a sudden, you're going to have to do all these things. So we do ask for business plans, which is a thorough game plan on how you're going to make your practice successful. Here is a thing that we're going to talk about a lot. We're going to expect you to have professionals around you, your advisors, a CPA, an attorney, an insurance agent, an equipment broker, maybe a practice broker, a real estate agent, right? We're going to want you to be surrounded by all these things. And so they're all super important. And so it's really something that I would tell you is really, really important for you to get that around, right? And so startup practice, we definitely do them. There is a lot of advantages too. Now you can put the practice, make it look the way you want. You can hire a new staff. The patients come in and they're new to you. They don't have any preconceived notions about the old doctor. Now, obviously, they're going to have a doctor previous to you, hopefully. So they may have some biases there, but for the most part, you can develop your culture, your practice the way you want to. So it's really great. The next step, the one in the middle, this is a great step into becoming a full owner. You buy into a partnership, or you're a half owner of a practice. There's an ownership transition. Teammates like it because they get to see you and the older doctor. They get to kind of ease into things. Patients like it because you know what? They trust the old doctor. You're probably going to be younger than the other doctor, so they're going to, kind of have to feel you out a little bit. And they'll get to see the older doctor mentor you, the younger doctor. They're going to get to see you guys interact, and patients love that. And then last, the bottom one, the full buyout, right? And this is probably the most popular one we see. We do a lot of these. Usually the seller puts their practice for sale, or they sell to their associate, and they go out there and they put it out for sale, just like you would a house or a car, and people bid and visit the practice and you make an offer. Those are great. And the transition could be anything you want. The old doctor may stay, the old doctor may leave. The old doctor may continue to be your associate while you may work somewhere else. There's a lot of different things. It's very flexible. And so I am very skilled at these. I've bought over 100 practices, and I finance I think it's about 200 practices. So I've seen a lot of different things here, and they tend to work out really well. And the bank likes these, and the bank likes all of these, and we finance all of these all the time. And we would love to speak with you about that. But as I said earlier, one thing about PNC being a full service bank is we don't just do the loan for you. So in this little diagram here, it talks about finding your practice, negotiating the terms. I call it due diligence. You document, you get your financing in order, you get the legal documents. Your lawyer helps you sign the employment agreements, the asset purchase agreements. You have to sign a new lease with the landlord. So you got to do all these things in the first two phases. And a lot of people make the mistake of focusing on the loan in these first two steps. I am here to tell you the real work with your bank starts at phase 3 when you take ownership, because our goal here now is to help your patients make their payments, help you pay your vendors, help your employees get paid, provide benefits to your employees and your team, help them with retirement planning and yourself, help them be viable members of the community, because at the end of the day, phase 4, we're all going to want to create an economically viable and sustainable practice, one that you're giving great patient experience, great patient care. But at the end of the day, you got to make money. You got to pay your loans back. You got to pay your student loan back. You got to have a mortgage. You got to take some vacation time. We got to save for retirement. And so your bank has to be your partner. So we don't want to focus on phase 1 and 2 so much. We want to focus on phase 3 and 4. We want you to have a partner together, right? And so this is where, when you have a partner, a trusted advisor, you really need these people in the middle row here. You do your own due diligence. You use your gut. Does the practice feel right? But you got to lean on accountants, practice consultants, builders, equipment vendors, got to have a lawyer. You got to talk to your banker. All of these people here are there to help you. Some of them cost. Your banker's free. We don't cost. And so they can help you go through all those questions on the left. You work with your mentor, you work with a professor, you work with your classmate. Talk to everybody about this. Get as much advice, free or pay, that you can. Do never cheap out on a lawyer. It's so important. Those of you that are about to graduate, those of you that just recently graduate, have somebody review your employment contract. If you go work for a group or you go work for an individual dentist, you got to make sure that employment contract's fair. Real quick, I'll just stop and pause. I'm just checking to see no questions out there. If anyone has any questions, Q&A, I don't see any. Please speak up. But does the practice make economic sense? So you're going to use your advisors to help you with that, right? Do the math, do the accounting. How much money will this cost me? What is it going to, how long is it going to take to pay off? How much money am I going to be able to bring home to have my life? Number 3, sufficient cash flow. Can I pay my loan? Give myself some money to live my life, have extra, build equity. Am I going to have a sustainable future? Are my employees going to be able to get raises? Am I going to be able to help them save for retirement? Am I going to help them provide health insurance? All these different things to make economic sense is really the key to the whole thing. We don't want to start off with buying a practice that just isn't going to work for you. And now when we talk about financing a healthcare practice, I got a polling question coming. So for those that have talked to a banker about financing their own practice, was it a healthcare specific banker? Yes or no? And if you haven't talked to a banker, then obviously C, which is NA. So we'll give you a few minutes to answer that and we'll lock it in.
It's not launching, Michael. I'm trying to get it to launch for you.
All right. I can skip. If that launches again, just let me know.
Okay, will do.
All right. I think I just skipped another page right there. Let me go back. Thank you, though. So again, we talked earlier about credit, right? And unfortunately, this is going to seems like a harsh term, but your credit score is number 1. How do you pay your bills? How much credit do you have outstanding? How long have you had credit? That's unfortunately one of the 4 C's of credit. We call it your character. The cash flow is how much money does the practice make? Is it enough to pay your bills? Collateral is the practice's ongoing revenue, historic revenue. We do a practice value based on the revenue and the cash flow, and we come up with the collateral that we allow you to lend. So that's the collateral. And last is the conditions. Is the practice in a position to grow Do you got a lease in place so you can stay at least the term of your loan, which is normally 10 years? Is the area you're going to conducive for a growing active community? Those are the conditions. So those are the 4 C's of credit that all loans are going to be approved on. And now all banks, as I said earlier, like to lend money, but there's a huge difference here. And why I asked that polling question, two different banks in my mind when you look at healthcare lending. You got your traditional bank, sometimes your community banks, your credit unions, some large banks that just don't do healthcare. They'll need good personal credit. The key, though, is they'll need a big down payment. They'll need personal collateral, which is normally like a house. The SBA loves to do lien your personal residence, your home. And that's what the SBA is. The SBA is a great program. Unfortunately, though, it does come with costs. Your interest rate flexibility may not be as great. They do tie to prime rate. So I typically can be much lower. So that's what you're going to get at your traditional bank. At a healthcare specific lender like PNC, yeah, you need that good credit. We talked about that. We need to practice the cash flow really well. And then if you do have some cash in the bank, the liquidity, like Steve talked about earlier, having that rainy day fund, that'll help strengthen the deal. It won't necessarily kill the deal. And so, yeah, as you can see, the industry specific lender is going to be much easier for you to get the loan than it will at a traditional bank. And so, why do I say that healthcare practices need to have a specialist like our team at PNC? It's because healthcare is more difficult and different than other businesses. It has complex revenue streams, right? Insurance. Think about when you go to the store, you go out to dinner, you buy the goods and services and you pay right away. As you guys know, in healthcare, you leave. You may make a small payment. We wait on insurance. People get denied. People argue. It's very difficult. And a lot of times in these dental practices, there's multiple owners. There might be different ownership portions. Most people don't understand the collateral because you can't just lien a building. So it makes it much more difficult. But at PNC, we have healthcare lenders out on the street. Each market has their own. We have over 100 across the footprint. Our underwriters that work at PNC Bank, that's all they do. They only review applications from doctors, dentists, and vets. So they're continually working on the same type of deals. And we're basically up to par. Like myself, I'm out speaking at dental schools. I'm out speaking at different societies. I'm out speaking at local events and study clubs, all on the different things that are out there, right? And so you definitely need to find yourself a healthcare specific lender, one that's going to have your back, one that's not going to focus on the loan and the due diligence so much, but they're going to be with you as a partner as you progress, right? And so I really wanted to kind of knock that in. Now, here is the last part of my presentation. I know we got a few minutes to go here. Different ways, and we're going to be able to share this with you, but our website for private practices is PNC Healthcare Business Banking. Our PNC Healthcare site is for the hospital systems and our large insurance payers. We do have some economic reports, our media room about our stock and things going on with the company. And then, of course, my LinkedIn, I'd love to connect with you guys on LinkedIn. I am open to answering questions, giving advice. Just if you want to hear, I'll hear you out on some things that you're thinking about doing. I'm open to do any of those things. And real quick, were we able to get that poll, or did we get that or not?
I was trying and it's still
Okay.
not allowing it to launch. I
All
apologize
right.
for that.
No, that's okay. I see there's some questions in here. Maybe can PNC offer more competitive? Yeah. So what's interesting, and SBA loans are great. Now, there are things called the 504 loan program, which is for real estate. Those offer, they're called debentures. They come out and they sell bonds for those. Those are very competitive. And they give you 20-year fixed rates, which are really great. And sometimes we'll use those. But we price off government treasury bills and different things like that. And we self-fund our lending. So you can typically get better rates than you'll find at the SBA lenders. They're pricing things off the prime rate. And so you should find yourself with a more flexible rate through a healthcare lender that's using fixed rates. So the answer to that would be yes. And then this one here, somebody wrote C. I don't know if they were answering, I'm not sure what that one is. But that is it from my end. I really appreciate the time here tonight. I think we have a few minutes left if we have anyone that actually wants to just shout out a couple questions.
There's a couple more still
Oh,
coming through, Mike. And also, there was a question that came up earlier after Steve got off that I want to make sure gets addressed. You mentioned it earlier, but it's what type of IRA would you recommend was one of the questions that was asked. And I want to make sure we answer that.
Sure. Thank you, Linda, for that question. And I should point out that I'm not licensed to sell financial investments at all. I'm not sure, Mike, if you are, but
not.
generally, um, depending upon what your tax status is, really helps you decide which IRA is better for you. Generally, if your tax rate is lower now and will be higher as you approach retirement, it's generally considered that the Roth is better for you. If it's the converse, then a traditional IRA. I strongly suggest that you consult with a financial professional. And when you're ready to set up those retirement plans, you certainly want to make sure you're speaking to someone who can give you that best advice. But generally, it's based on your tax status more than anything. Thank you.
So the
I
great
know we
question.
have a couple minutes left, Michael, but I was able to get the poll to work if you want me to launch it.
Yeah. Do you want me to answer this real quick?
Yes,
The
go ahead.
question's in here. Yeah. So the one that asked about a great competitive interest rate on a 10-year term, good deal. If you can get below 6, that's a really good rate. Now, I will tell you, if you're going to be getting that good interest rate, be prepared to have a full banking relationship with that institution, right? So your checking account where you do your operations, get online banking. They'll offer you your credit card processing. One of the keys, especially with our young doctors, we automate. So meaning you can send text to pays, you can send online click to pays online on your web page. And we have technology that your staff won't have to post those payments that are done that way. That'll automatically upgrade in through your PMS system. So a really cool things going on there. But to get the best competitive rate from most banks, you're going to have a full banking relationship. So I just wanted to kind of mention that. Amin, Karmali, how much initial capital do you potentially need? If you're just buying the practice, PNC Bank and healthcare lenders, we finance 100% of the practice purchase. And a lot of times I can provide working capital, which would be extra money to maybe help you give you some time to make payroll. Maybe there's a delay in your insurance because you have to get re-credentialed. Maybe you need to spruce up the office just a little bit, maybe a new paint job or whatever. So typically, you don't need any initial capital. We'll finance 100%, even maybe more of 100% of the purchase. So that's a great question. Dr. Patel here. Let's see. I saw that question. Now I can't see it right now. It went down below. How much capital do you need for the startup? And then the next one, I can't see Dr. Patel's question. Can anyone see it? Oh, do you offer a full team, CPA? So great question there. So our bankers, as I told you earlier, there's 100 of them across the footprint of PNC. So when you work with your PNC banker, they absolutely have a team of advisors that they work with. We call them centers of influence. They're people that we trust, that we work with, that we refer our clients to, and they'll be CPAs, dental specific, attorneys, dental specific, leasing agents, equipment vendors. We'll have them all. So what's really nice is we'll give you referrals and then we ask you to meet them, have coffee with them, sit down and talk with them. We can make introductions to them for you. we can help you do all those things. So 100% we will have advisors. I will tell you though, don't ever feel obligated to use that advisor. Talk to your classmates, talk to your mentor, talk to everyone and say, hey, do you have any CPA you can recommend? I will tell you though, don't get an attorney that does divorce law, DUIs, or criminal law. You want an attorney that does medical and dental practice law. That is not a place for you. I know, money can be tight, but you need to spend the money while they're in that area. Get yourself a really good attorney. That'll be my last one there.
Okay, did you want to launch the poll or you want to
Yes,
do?
please.
Okay, go ahead. There we go.
All right. So again, if you spoke with a banker about financing your own practice, was it a specific healthcare banker? Yes or no? And if you haven't done it, then just don't answer it, I guess, right?